Bond yields have taken a tumble, and this sudden drop has caught the attention of many investors. Like a runaway bouncy castle rolling downhill, they've plummeted, creating a wave of concern across the financial markets. This is a big deal. Investors are on edge, analysts are busy recalculating their strategies, and everyone is trying to make sense of the situation. Bond yields are like the interest rates on bonds. They represent the return an investor can expect to earn if they hold the bond until maturity. Low yields usually mean investors are nervous about the economy. They're seeking safer investments, indicating a lack of confidence in more volatile markets. Think of it this way. When investors flock to bonds, it drives the prices up and the yields down. Imagine you have a tenner to lend. You want to make sure you get a good return on your money. Your mate offers you a rubbish interest rate. A tiny one, it's hardly worth your while. Would you lend to him? Probably not. You'd look for a better deal elsewhere. You'd think he's going to blow it all at the pub. It's a risky proposition. It's the same with bonds. When yields are low, it means investors are willing to accept lower returns for the perceived safety of bonds. Low bond yields suggest investors are parking their cash in bonds, moving away from riskier assets. They're worried about the future and want safe havens. Bonds are seen as a safer bet in uncertain times. Not exactly a vote of confidence in the economic engine, is it? When bond yields drop, it often signals broader concerns about economic growth and stability. Bonds are having a moment. In the midst of market turbulence, bonds are shining brightly. They're rallying like it's 1999. Investors are pouring in, hoping to find a safe haven. But hold your celebratory champagne. This surge isn't all about good news. This isn't necessarily a cause for street parties. The streets remain quiet, reflecting the underlying concerns. This rally is driven by fear, not excitement. The faces of traders and investors tell a story of anxiety. Investors are piling into bonds because they're scared. They're seeking refuge from the stormy market conditions. They see storm clouds gathering over the economy. The signs of economic trouble are hard to ignore. They're worried about a recession. The fear of an economic downturn looms large. A recession is like when your car breaks down and you can't afford to fix it. It's not ideal. It disrupts lives and plans. So they're flocking to the perceived safety of bonds. The rush to bonds is a flight to safety, even if the returns are as exciting as watching paint dry. Safety first, right? In uncertain times, stability is the priority. The Federal Reserve, or the Fed for short, is like the economy's ringmaster, orchestrating a delicate balance. They try to keep everything in check, ensuring the economy runs smoothly without overheating or stalling. One of their biggest jobs is controlling inflation, which can erode purchasing power and destabilize the economy. Inflation is like when the price of your favorite lager goes up every week. Not fun, right? It means your money buys less and less. The Fed uses interest rates to try and control inflation, adjusting them like a dial to maintain economic stability. They raise rates to cool things down, like turning down the thermostat in a room that's getting too hot, slowing down spending and borrowing. Conversely, they lower rates to stimulate the economy, like giving it a shot of espresso, encouraging spending and investment. Right now, they're stuck between a rock and a hard place, trying to balance the need for growth with the risk of rising inflation. It's a tough job, but someone's got to do it. Section 4, rate cuts on the horizon. The potential impact on markets. The big question on everyone's lips, will the Fed cut interest rates? The bond market reckons they will. They're pricing in rate cuts like there's no tomorrow. Lower rates could give the stock market a boost, like a shot of nitrous oxide for a sputtering engine. But it's not all sunshine and rainbows. Rate cuts could also signal that the economy is in worse shape than we thought. It's a double-edged sword, this one. Section 5, Berkshire's Big Bet. Reading the tea leaves of stock market reactions. Warren Buffett, the Oracle of Omaha, is a legendary investor. He's like the Sherlock Holmes of finance. And his company, Berkshire Hathaway, just made a huge bet on the US housing market. Now, what does this tell us? It suggests that maybe, just maybe, there's life in the old economy yet, that perhaps the recession everyone fears isn't a foregone conclusion. Section 6, crystal ball gazing, what's next for bonds and the economy? So what's the verdict? Is the economy about to drive off a cliff, or are we just hitting a few bumps in the road? Honestly, nobody knows for sure. Economists are about as accurate as a weatherman predicting snow in July. The bond market is pointing towards a slowdown, maybe even a recession. But the stock market is still optimistic. It's a confusing time to be an investor.